All right, welcome to this explainer, where we are going to completely unravel what I like to call the central mystery of the modern economy. Seriously, just look around you for a second. Your neighbor is probably paying off a mortgage, right? A student down the street is financing their education. Businesses are borrowing billions, literally billions, to build massive factories, and local governments are issuing bonds just to fix the potholes on your street. It seems like the whole world is borrowing. But here's the catch. Every single time someone borrows money, someone else has to be lending it. And that brings us to a question most people never actually stop to ask. Honestly, it's kind of the elephant in the room of global finance, but it's exactly what we're going to answer today. If everyone is in debt, who actually owns that debt? Like, who sits on the other side of all these transactions? And maybe more importantly, what happens if the borrowers suddenly can't repay? Because you see, debt isn't just some abstract number sitting on a boring spreadsheet. Debt is a promise. It's a promise that money will be returned in the future, and our entire global economy is essentially built on billions and billions of those invisible promises. So, Section 1, the micro, the simple loan. Okay, to truly understand this massive global debt machine, we have to start small. Let's bring it back to you. Imagine you want to buy a house. Let's say this house costs 50 lakh rupees. You've been super diligent and saved up 10 lakh, which is great, but you obviously still need another 40 lakh to actually make the purchase. So what do? Well, you walk into a bank, you sit down, you sign a literal mountain of paperwork until your hand cramps up, and they hand over a loan. You promise to repay that money over time, plus interest, of course. Now, from your perspective, sitting right there at the closing table, this feels like a massive, heavy personal liability. You have taken on debt. But I want you to flip the script for a second. Look at it from the bank's perspective. To them, that 40 lakh loan, that's not a liability. It is a highly valuable financial asset. The bank now expects to receive money from you every single month for years. Your debt is quite literally their future income. So this is the big paradigm shift here. Every single debt in the world is someone else's financial asset. The exact same money that feels like a huge burden on your personal balance sheet is a fantastic wealth-generating asset on someone else's. And that simple concept, that is the spark that starts the entire debt machine.
Moving on to Section 2, the spotlight. Why companies rely on debt.
Let's zoom out now to the really massive engine of the modern economy, which is corporate borrowing. Why do giant, wildly successful companies rely so heavily on debt? Well, imagine a major tech company racing to build a state-of-the-art smartphone factory. It's going to cost a staggering 1,000 crore rupees. They basically have two choices. Choice one, they use their own cash. But the problem is, saving up that much cash takes time. It means slow growth, waiting for years of revenue to just sort of trickle in, and crossing your fingers that a competitor doesn't beat you to the punch. Then there's choice two, using debt. By borrowing the money, the company gets an immediate 1,000 crore injection. Boom, they build the factory today, they start producing goods tomorrow, and they capture the market instantly. In the cutthroat corporate world, time is market share. Debt absolutely isn't a sign of weakness for these companies, it is a literal superpower for fast expansion. And this debt fuel doesn't just build factories. It's the ultimate war chest. Companies use it to gobble up their competitors and major acquisitions, or to lay down thousands of miles of fiber optic cables across the country. And actually, it's also a survival tool. It acts as a financial cushion that keeps the lights on when the economy takes a sudden nosedive and regular cash flow dries up. It really is the ultimate corporate fuel, allowing businesses to grow at just lightning speed and totally dominate their markets. But you might be wondering, where on earth do these companies get this kind of massive funding? I mean, they aren't exactly walking into a local bank branch for a standard mortgage, right? No, these corporate giants tap into something called the bond market. By issuing bonds, a company can completely bypass traditional banks. Instead, they borrow directly from thousands, sometimes millions of different investors, all at the exact same time. The company gets the huge sum of money it needs to grow, and in exchange, all those investors get a promise of regular, steady interest payments. Next up, Section 3, the macro, the government borrowing engine. Now, companies certainly aren't the only ones utilizing this strategy. Governments do the exact same thing. Governments spend astronomical amounts of money to build roads, railways, and hospitals. But here's the reality, their tax revenue doesn't always cover the bill. So they borrow by issuing government bonds. And if you look at who actually owns all this government debt, it's fascinating. It's not just held by foreign nations or a handful of mysterious billionaires. It's distributed across pension funds, insurance companies, banks, and foreign investors. Basically, if you have any kind of retirement account or a mutual fund, a piece of that national debt is quite literally your personal savings. And sitting right smack in the middle of this massive tangled web are the banks. They are the ultimate middlemen of the world. Think about it. When you deposit your paycheck, the bank records that as a liability on their end because, well, they have an obligation to give it back to you whenever you ask for it. But they don't just shove that money in a dusty vault. No way. They turn right around and lend it out to those very companies and governments we just talked about, turning those new loans into bank assets. They are constantly transforming your everyday, ordinary deposits into the very credit that fuels the entire global economy. Which brings us to a pretty wild realization. This isn't just a local or even a national phenomenon. We're talking about a deeply interconnected global web. The world's debt isn't just some collection of isolated, separate loans. A financial institution in one country very often owns the debt issued by a government or a corporation in an entirely different country. Capital is just constantly flowing across borders. We are all, whether we realize it or not, financially linked together through these global, cross-border promises. Which leads us to Section 4, the threat, when the machine breaks. So, this immense, interconnected power is incredible, but it also creates a profound vulnerability. Because debt itself isn't necessarily dangerous. It's entirely about your ability to repay it. And things can get out of hand quickly. It usually starts with an initial borrowing phase. Simple enough. But then those interest payments begin to mount up. Suddenly, out of nowhere, there is an unforeseen revenue shortfall. Maybe a global recession hits, or a massive product launch flops. Now the company or government doesn't even have enough cash on hand to pay the interest, so they are forced to borrow more money just to pay off the old debt. It's like being on a treadmill that keeps speeding up. The debt grows way faster than the income, and the machine starts moving backward, destroying economic growth instead of creating it. And eventually, if you can't stop that spiral, the borrower hits a wall. They default. They just flat out fail to meet their obligation. And let me tell you, when a massive company or a government defaults, the collateral damage is absolutely brutal, and it happens fast. Banks suffer severe losses on their assets. Everyday bond investors, people's retirement funds, see their portfolios wipe out. Employees instantly lose their jobs, and all the suppliers who provided materials for the business are left completely unpaid. It's a terrifying domino effect, where one single failure can trigger wide-scale panic. Because everyone is so linked, a localized debt crisis can become a systemic global meltdown almost overnight. When a major player stumbles, investors everywhere start to panic, banks totally freeze up and stop lending, and suddenly, a problem in one sector is a global financial crisis. As our source material perfectly captures, the problem isn't always the debt itself, it's the network connected to it. Finally, Section 5, Conclusion, a giant web of promises. So to bring this all together, the modern economy really is just a giant invisible web of promises. We've seen today that debt isn't just a boring number on a page. It is the very foundation of the world we live in. It builds our cities, it scales incredible, globe-spanning businesses, but it relies entirely on trust. The trust that people can and will keep paying, because everyone is connected. Everyone owes someone, and everyone is owed by someone else. So I want to leave you with this thought to ponder today. If our entire global structure relies on the constant, fluid motion of these promises, what happens when lenders become afraid? Trust completely evaporates, and the entire debt machine just starts to freeze.